I don't need to look at the price so much as long as those big dividend checks keep coming in.
Don't buy TSLY if you think Tesla is going to go down 50%. But some people go, oh, I want to use this to pay my mortgage. Okay, right? Just realize the risk you're taking.
And now a question that you're not asked as often. TSLY is one of the hottest ETFs right now, partly because of those huge dividends that have recently been in the range of 50 to 70%. We're joined by Jay Pestrichelli to talk about how sustainable those dividends are, the risks involved, and if this is a great match for you as an investor. Welcome, Jay.
Thankful for the opportunity to talk about the fund.
Terrific. I want to start with an easy one. How would you describe which investors are a good match for TSLY?
Yeah, I think it starts with how we would classify TSLY and the other YieldMax ETFs. We look at these funds as alternative income versus, say, stock or bonds, right? Anything that's not stock or bonds is alternative, right? Real estate or gold or oil, those are all kind of alternatives. Options fall into that mix. And so when we think about who the appropriate investor is for the YieldMax ETFs, it's someone who's looking for alternative investments, alternative growth. As you know, much of the returns are driven by the dividends are driven by the yield we can generate from selling calls, or the premium we could generate from selling calls. And so we put this in kind of the alternative category. It's not, I wouldn't say this is, even though we're doing the strategy on, I'd say growth stocks in general or higher volatility stocks. It's more about the options income. So it's really meant for the options investor, but someone who doesn't want to do it themselves.
I know that there are a few options investors in my community who are very familiar with the concept, but they just don't have the time to go through the option chains. And someone who's an active trader like you is obviously going to be better at it than them, so they're happy to outsource it.
Yeah, I mean, that's the point, right? That's one of the benefits here of these funds. I know people have heard about covered calls for a long, long time, and you've done a great job of covering, the structure of TSLY and ORK and NVIDIA and the others, and the idea that, we're selling calls out of the money, but we're trying to still get a good amount of premium to harvest the implied volatility. But that all sounds really complicated. I know that's not meant to be. Just the idea here is that, look, if you want to let someone that trades options all day do this for you, this is an easier way than setting up a direct relationship with an options manager and, going through option disclosures and all those kinds of things. You could just use a vehicle like an ETF, which makes it much more accessible to an active options manager like we are.
Okay, terrific. And now a question that you're not asked as often. How would you describe the kind of investor for whom TSLY is not a great match?
Yeah, I mean, you have to be, for TSLY specifically, let's use that as the example. I know that's the most popular YieldMax. You have to be still willing to take the risk of Tesla, right? Like any covered call strategy, the main risk is the underlying drops in value. When I say underlying, I mean Tesla itself in this example. So, don't buy TSLY if you think Tesla is going to go down 50%, right? That doesn't make any sense. You still have a covered call strategy here. So a covered call strategy, a lot of people always ask me, well, is that bearish? Is it bullish? Is it neutral? It's generally bullish. Like when you're in a covered call strategy, you want the stock to go up. Sideways is fine. Down a little is okay. You have a little bit of, I don't even want to use the word buffer, but you have a little income to offset small losses from the premium we get from selling calls. But if you're bearish Tesla, you should not buy TSLY, right? You still have to have an idea that, the risk of Tesla is in your portfolio. So if you are someone who doesn't have risk tolerance for a high flyer like Tesla, you shouldn't buy TSLY. If you have, a risk allocation, fine. By the way, you could go down the scale in risk. We have some ETFs like APLY, which is done on Apple, obviously less risky than Tesla, but based on volatility alone, right? I'm not making an assessment of the company, but I think it's when you look at the volatility of the stock itself, that's how we in the advisor community manage, assess risk. We say, what's the volatility? What's the chance that this thing can drop 50% in a year? And the chance that Apple drops 50% is much lower than Tesla. So there's definitely a give up here that if you still want this alternative income, you have different choices other than Tesla or TSLY. You can use our Apple version, which, by the way, like all things, has a lower yield, right? Lower risk, lower yield, right? Those things are commensurate always.
So continuing with this theme, I want to run a few statements by you, and you can just give me your quick reactions to them, because these are things that I've seen come up in chat rooms between investors talking about the YieldMax funds. So here's the first one. TSLY goes up and down with Tesla, plus you get huge dividends.
You have any comment on that statement? Yes. So it will only go up so far with Tesla. Like all covered calls, we cap the upside. That's what we give up for those high premiums of selling calls. So I'll give you a great example, right? So Tesla, I took a look this morning, so excuse me for a second here. This morning, Tesla was up for the year 75%. TSLY, including dividends, was up 40%. So you will give up some of the upside with the YieldMax ETFs. That's the give up for the yield. It's not about going up with every tick on the way up. Now the downside, you will experience most of the downside, right? TSLY will go down when Tesla goes down, minus the amount that we earned from selling calls, which for TSLY at this point is, about 1% a week. Like if you were to watch on a weekly basis, if Tesla goes down, which it's been going down over the last few weeks, 4 weeks, we go down by about 1% less per week because that's the amount we made from selling calls. So it's really, it will move up and down daily with Tesla, but the upside is capped and the downside will be mostly experienced minus the amount of the calls we sold.
Terrific. Okay, that's a great answer. So next statement. The price of TSLY doesn't matter because the dividends are so huge.
No, it definitely matters, right? So if I was to think of the two components that were important to the dividend, it's the volatility of Tesla. That is number one, probably number 1, 2, and 3. And then number 4 would be the price of Tesla itself. So in the example I just gave, right, I just said we're kind of selling calls around 1% a week for Tesla. That is based off of the volatility where it is. And so if the volatility stays there, we'll make 1% a week. But if Tesla goes from 280 down to 200, I used to sell those calls for $2.80. Now I'm selling those calls for $2 even. And so what happens is we earn lower dollars based on the lower stock price. We earn greater dollars based on the stock price when it goes up. And so it's definitely a function of the underlying stock. So for example, let's say we're kicking out, 1%, $1 as the yield for TSLY, right? If Tesla gets cut in half, TSLY will drop most of that. And then we still may kick out the same percentage, but it'll only be 50 cents because the underlying stock dropped, right? So we won't always kick out $1 regardless of where Tesla is trading. If Tesla goes up, that dividend will go up. If Tesla goes down, the dividend will go down. The rate will probably be similar, but since we're selling so actively, it's a lower dollar amount or I'd say cents or dollars in the yield itself, in the distribution itself.
Okay, I think that's a really important clarification because I think some people have been thinking, I don't need to look at the price so much as long as those big dividend checks keep coming in, that's what I'll focus on. But you've made a really good point there that you can't assume that if it's $1 in dividends, or I think it was 83 cents, the last one, that it will always be that amount if the volatility remains constant. The price of Tesla is a factor.
Totally true. That's exactly right. And, it works both ways, right? As Tesla goes up, we'll probably have a higher dividend amount as well, right? So it does cut both ways when it comes to the price of Tesla itself, right? The argument I've heard from folks has been like, hey, I don't care if Tesla drops 50%, I'm going to get 50% in dividends, so I'll break even for the year. It's not necessarily true. It could be, but it probably won't be, right? Because as Tesla's going down, the dividend amount will be going down as a percentage. It'll be, the dollars will go down. The percentage may be the same, but the dollar amount will go down. That's definitely a risk with these, no doubt.
Right. Okay, that makes perfect sense. So the next one is an example that I came up with. This one is much more broad. We've given a couple of specific kind of technical elements. This one's more broad. Just imagine you had a client, they're a retired couple, and they're earning 5% on their conservative portfolio, and they heard from their neighbor about this TSLY and how great it is, and that they could make 10 times that, and they're very excited, and they've got visions of buying fancy cars and going on fancy vacations with all this extra income. So if you're going to explain this to them and kind of calm them down a little bit and give them some realistic expectations, how would you do that in simple terms?
Yeah, I would say, measure your risk with how much risk appetite you're willing to have, and then that should dictate how much of this position you should put on. Generally speaking, I would ask them first, are you comfortable with the risk of Tesla itself? Because that's the risk you're adding to your portfolio. If they're not, then they shouldn't have any. If they're willing to say, oh, I'll use it as a slice in my build of portfolio that's kicking out yield, that usually makes more sense. I certainly wouldn't want someone who's retired and is concerned about their monthly income from the yield of their portfolio because their risk tolerance just is not high enough. But having a slice of maybe a lower volatility one like Apple or Meta or Google, which are some of the newer ones that we've put out, might make sense. And those still have a fairly impressive, they will have a fairly impressive yield. We haven't had a payout on those yet. But if you know the volatility of Google and Meta and Netflix, then you can have an idea of what the yield will be. I would say back to your example, you have to be comfortable with the risk of Tesla, and that should dictate how much of Tesla you should own.
Right. Okay. That's a good explanation. And I want to remind folks that we're focused on the risk today. But if people want to know just the basics of how the fund works, I've got a video about that. So let's move along. And I want to give a more specific example, which is me, because in the video that I've already put out about TSLY, I said at the end that I didn't buy it. And I mean, I didn't buy 99.9% of all funds because there's thousands of them and I only have, so many.
One's taken. It's okay. No one's offended here.
Okay, great. So I'll explain where I'm coming from and you can tell me if I've missed anything. So I'm a retired buy and hold income investor, and I'm typically comfortable with risk in the range of about 8 to 10%, which is higher than some people, lower than others. And that comes mostly in the form of income. So that tends to look like BDCs, REITs, closed-end funds, preferred stocks, covered call ETFs like JEPI, that kind of thing. So obviously, I would love the TSLY dividend. Who wouldn't? My hesitation is with the risk associated with the net asset value. Two things. The price, that's the obvious part of Tesla, which we've already discussed, and then the specific path that's required in the event that Tesla goes down for it to recover. So I focus on those two risks, and I'm not a good fit for that. So does that make sense to you, or am I missing something?
Well, I would. So again, we haven't rehearsed any of these questions, so I'm gonna give you kind of a question right back since we're talking about you specifically, and you can answer for yourself. So last year in 2022, did you close any of your positions when they were down more than 10%?
Last year. No.
Right? No, you probably didn't. Most people did not. But the markets were down pretty badly. I don't know any asset class that wasn't down. By the way, with the exception of some option selling strategies that we're familiar with, that we run, nothing was up last year. So when you tell me your risk tolerance is 10%, I ask you, do you really have a risk tolerance of 10% and close out your positions? Or it's, what do you do when you feel uncomfortable, right? And so on that, listen, I know I'm putting you on the spot there, but I would say you probably have more than a 10% risk, especially investing in REITs, right? Anything that's paying that level of a yield can actually carry more risk than, say, a treasury that's paying a 5%.
Oh, a lot more.
So,
dramatically.
Yeah. So you're also fairly young, right? You're going to be investing for, let's just say, you're going to live into your 90s, like most people our age will. You've got 40 years of investing left ahead of you, right? And so avoiding risk can be actually a tactical mistake. There needs to be some part of generally speaking, especially somebody your age, you should have some part of your portfolio that has the chance for outperformance, right? So I would probably push back a little bit based on your behavior of not selling. If you told me you went to cash last year in March or April, then I would say you truly don't have the risk tolerance that it would take for a TSLY. But you didn't. Right. So having a piece in your portfolio might actually be okay for you. I'm not saying put 20% of your portfolio, but totally avoiding things that can have an alternative set of growth, like not stock or bond, growth parameters, like a TSLY, which is more options-based, can be helpful to create diversification in your portfolio and could give you a chance for a little bit of outsized growth when the markets go up. Generally speaking, markets go up, having exposure to stocks is generally important for someone that's going to be investing for the amount of time you're going to be investing.
Right. Okay. That's a pretty good sales pitch.
I mean, I talk to investors all day, right? We have wealth clients, direct wealth clients, and then we have ETF investors, right? I just, always put it in perspective of, I get the risk you don't want to take, but what is the risk you actually have taken? And then having something that will reward you for that risk is probably important.
Right. And of course, we keep coming back to the underlying Tesla. A lot of it is your opinion of that stock too, which is separate from the discussion about the volatility.
Agreed. Right. The way we started, it was, hey, you have to be comfortable with Tesla risk to be in TSLY. It's why we're putting so many of these out. I think we've got 9 of them out today. We might have 20 out by the end of the year, so people can pick and choose. Right. You may see, Microsoft coming out shortly, Exxon, JP Morgan. So we're kind of moving, broader away from the, tech heavy names, which have the most volatility, to less volatile names that people say, oh, I'm already in JP Morgan. I'm comfortable with the risk and I'm taking their 2-3% yield. Why not, okay, I might be okay having some YieldMax in my portfolio for something that's not as volatile as Tesla.
Right. That makes sense. There's plenty of people who not into Tesla, but very much into Microsoft, for example. Very different type.
NVIDIA is a great one, right? We got earnings coming up shortly. That one is our second most popular ETF right now, because maybe you're in the AI, camp. Then great. Play NVIDIA with YieldMax.
Okay. So let's shift from the investor and focus more on the market. Which market conditions would you say are optimal for TSLY?
Yeah, like all covered calls, the general bullish market is better for any covered call strategy, right? Because the first and foremost, we talked about the risk, which is the underlying stock. So if in a bear market, covered calls aren't going to be the greatest for you, right? You're still going to, yes, you may not lose what the underlying loses, but you're still in a position where, your main risk is exposed. Sideways markets are okay. A lot of people would say sideways markets are the best for covered calls. We actually, because we sell calls that are slightly out of the money, unlike you mentioned JEPI or even QYLD that sell at the money calls that are capped right away, we give our underlying tickers a little room to run up. So a bullish market is good for YieldMax, for the YieldMax strategy in general. If the market runs, like if TSLY was to go up 20% next week, it's fine. We'll make 5-6% that week, which, that's fine, but we would have missed 15, right? We'd much prefer a nice, slow grind up, although when that happens, the volatility shrinks. So, we want kind of a market that maintains some of the volatility for the call selling premium, but also has a bullish bias.
Okay, that makes sense. And then to flip it around, the worst market conditions, just a bear market, is it as simple as that?
Downward market, yep, that's the worst.
So at this point, I want to mention a couple of assumptions I made in my original TSLY video that subsequently I think maybe were not correct. So let's correct those. First one is, I assumed that you write the calls monthly because a lot of covered call funds do that. But actually, after watching some of your interviews, you write them more frequently than that, weekly, right?
Yeah, that's correct. We're definitely an active manager, right? Whereas a lot of the other existing covered call strategies are almost more indexed, right? They have, the day they're going to sell their call, exactly where they're going to do it, and they do that once a month. For us, we definitely apply a little more active management, which we think is important with options. I'll give you an example. Over the past few weeks, we just said Tesla has been kind of going down. Well, if our goal is to earn call premium, earn time decay, then why not earn that time decay as often as you can. So we may trade out of our positions a lot more often than weekly, right? We may get into a position and cover buy it 3 or 4 days in if almost all of the time value has been sucked out. And so we've been actually very active over the past 3 weeks with all of the YieldMax ETFs of selling an out-of-the-money call. If the stock goes down, we repurchase it and sell a new one to try to earn that weekly premium more than once. And, I know we're early, still the month isn't over yet, we're into the 3rd week, but, we may end up selling calls 5 times, maybe 6 times for TSLY if the downward march continues. So that is one of the benefits of being active. And then the other side of it is when the market's going up, sometimes your calls go in the money. Happens all the time, actually, right? So actively rolling those calls up to capture more of the upside. Once all your time decay has happened, you can have time decay on the upside as well. It's not always on the downside. Time goes forward. It's the only thing I can guarantee about the stock market is tomorrow comes after today. So once you've earned your time value, even when it's going up, re-roll, right? Don't limit yourself for a whole month on the upside of a particular underlying.
Okay, that makes sense. So thanks for clarifying that one. And we'll come back to the active part in a minute. But the second assumption that I'd made in that previous video that I wanted to correct was that you're writing covered calls on 100% or the equivalent, because you don't have the underlying, but the equivalent of 100% of the portfolio. Is that how it always works, or do you sometimes write calls on less than 100%?
Sometimes we'll have calls on less than 100% because of the active management. Some days we may have only half calls on, right? Because we made our money on, most of it already, right? And we might have taken those off. So generally speaking, our intention is to sell calls on 100% of the notional, but there's certainly, we had the flexibility and discretion to only do some of it based on what's going on in the market. So we're allowed to make not that we make a market call, but more like, hey, it's okay. There wasn't a great call today, right? We covered one back. There wasn't a great call. Let's give it to tomorrow before we, fill the whole position. Generally, we want to be fully covered, but, sometimes we will have days where it's not 100% at the end of the day.
Okay, that makes sense. So then, given those two things, I'd said in the video that the upside is capped at 15%, because in your prospectus, that is the number that's mentioned, 15% per month. But given that you're writing them more often than monthly, the potential upside in a month would be more than 15%. Is that correct?
It could be, sure. Yeah, because, we could sell, I'll give you an example for NVIDIA, right? We've sold calls at the 490 strike price, right, for 1 week out because there was so much more volatility in the options because earnings were coming. Everybody remembers what happened last earnings, right? It went up 30% a day.
Yeah.
So we could get farther out in a week. I think we were 9%, 9.5% out at the time when we wrote some of those calls. So I could make, 9% of the upside in a week plus when I earned on the call selling. So, arguably if I did that 4 times, I'm 40% out of the money. That probably wouldn't be the case, but we could capture more than 15% of the upside on a monthly basis. We really try to give ourselves enough room to capture upside on that weekly basis. So if a stock has kind of a steady march higher, then in those scenarios, we should be able to, there's a chance that we capture more. It all depends how it happens, right? You have a spike up in a single day like NVIDIA. When it did that last earnings, I think we made 8% that day and NVIDIA was up 30%. And then NVIDIA kind of went sideways for a while. We didn't recapture all of what we missed on the upside. But again, that's not our intention. I'll bring it back to the goal of the strategy is alternative income. NVIDIA or Tesla are just the vehicle we're using to harvest that volatility. So it's not always, we really don't love to compare ourselves to the stock. I know everybody does. It's the natural thing to do. But for us, it's about, can we deliver, these higher yields by harvesting volatility out of the call selling activity?
Okay. So I want to bring it back to the investor then. Some investors see these dividends and they get kind of big dollar signs in their eyes and they're starting to think about what they could do with the money, spend the money, right? So those investors maybe withdraw the dividends and then the other investors compound. You've mentioned in other interviews that that's very common to to reinvest automatically. So can you explain the difference in outcome between those two extremes, the one who withdraws everything and the one who reinvests everything?
Yeah, so, what'll happen is when you have such high yields, right, the price, the NAV, the price of the ETF goes down by the amount we distribute. So let's use the example of, let's say, at 100 shares and we distributed $1, right? You get $1, you get $100 in dividends. It's like, that's great. That felt good. But the stock price dropped, right, by that dollar, right? If we were at $20 and we distributed $1, when we go ex-div, you'll get $1 of cash and the stock goes down to 19. Well, if you don't reinvest, now your market value is, 1,900. If you were at a $20 stock, right, for 2019, you went from $2,000 to $1,900 in your stock value. The next yield that you get will be based off of 1,900, not based off of 2,000, right? Because now look, the market value may go up, but let's just say market value stays flat. In that scenario, the yield you're going to get, it might not be $1, right? It might be less, it might be more. So you have the same number of shares, and if our yield goes down, right, you're not going to get the same amount. So one of the things the reason we talk about reinvesting the dividend is because putting that back in, you get back up to the $2,000 of market value, right? And actually, you'll compound your shares, which we all know the power of compounding, and you'll end up kind of improving the amount of yield you're getting by reinvesting those dividends, because you're really making an additional investment back into the portfolio. Whereas if you don't, right, you'll be kind of stuck at that one yield rate. So, look, I think it all depends what people, why they buy the ticker in the first place. If your if your idea is this is kind of a risk, alternative risky asset for me, which I would say TSLY falls into that category, then you probably should be reinvesting the dividends so that you've already known there's risk associated. If you're just going to take the cash out, you have this risk that the ETF drops and drops and drops as we're distributing the yield. Now, the flip side of this is as we're generating that covered call premium, the price of the ETF will go up. So let's say Tesla would happen to be flat for a whole month, right? We would tick up 1% a week if we could sell calls for 1% a week, right? We would tick up, and then distribute right back down, and the NAV would drop to where we started. That's if Tesla was flat. Of course, it is not, but that's in vacuum what would happen there. Whereas if you reinvested that amount, yes, the stock would drop, but then your balance would go right back up because you've reinvested it, and then the amount you get paid on the yield next time would be higher, even in a flat market. So it's one of those things. It all depends how you're using these. How, what your intention is. In general, I'm a bigger fan of knowing why I'm invested in TSLY, because it's an alternative, because I'm trying to do something that's not stock or bond related. It makes sense to reinvest. But some people go, I want to use this to pay my mortgage. Okay, right? Just realize the risk you're taking. Back to that question.
Right. Okay. I'm glad you clarified that part, because you do hear these comments sometimes, and I know that you've emphasized in other interviews that you lean more towards reinvesting, so that explains the reason behind that.
It's just what you're using it for in your portfolio, right? I mean, that's like if you're like, if I want some kind of nice income that I can, pay my mortgage on, you're taking a lot of risk with your principal just using TSLY, right? Because you're taking Tesla risk. And you could get the benefit of Tesla going to 400 and your balance would grow and your yields would grow, and that would be great. But there is a flip side to that.
Okay. So I want to run a different strategy by you. We just said reinvest the dividends is preferable to withdrawing it. But if someone had this approach, give me your feedback on this. They withdraw all the dividends until they've got their original principal back. And if things keep going the way they had the last few months, let's say there's no disasters, that takes a year and a half or maybe 2 years. At that point, they've got their original principal back. They, by definition, can't lose. And then whatever's still in TSLY, they just start to drip that, let that compound. Well, at that point, they're playing with house money. It sounds great. So what risk stands in the way of that actually happening?
Yeah, it's the downside of Tesla as your risk, right? It may take you longer than 18 months to, get paid back for your original investment. So you're only playing on house money. It could take longer than the 18 months because the yield, while it may stay the same, the dollars per distribution will drop. We already covered that. I think it's by the way, I will tell you, we know some folks that are buying TSLY on margin because the yield is greater than their margin rates of 7, 8, 9%, right?
I wince when you say margin. Sorry, I wince when you say margin. They're leveraging it.
Yep, that's right. That's right. They're borrowing to own it because they think the yield will outpace their margin rate. And they're right on the yield, but again, the risk is that they've increased the risk. So I have seen people do that too, where they'll pay down their margin and then they're left with fully paid shares, after a year and a half. And by the way, they don't have to leverage the whole thing. It's all about. I am definitely not recommending that, right? But I just know some folks that are doing that because of the same concept you just mentioned. Like, hey, I could use the yield to pay down, whether it's my original investment or when I borrowed to buy the ETF. That can happen too. If someone is thinking that way, I would say they should either be careful. It's a risk question. It goes back to risk. They probably would like some protection. And then in those scenarios, and we do have clients within our practice that do this, we'll hedge their risk in the YieldMax ETFs, right? We'll go and we'll buy options, we'll buy puts. We usually actually use a basket of them, and then we'll buy puts on the Qs as kind of protection. It's a little more detailed. But in those scenarios, for maybe the first year or so, you do that so that, if things go wrong, if your idea is to eventually be playing with house money, it will take a lot longer if the stock drops. So buy some protection in those situations. That might not be a bad approach. I'm not against paying down, taking your dividends out. I don't know what you're going to do with those. Are you going to reinvest it? You're going to just let it sit in cash? Like that, what are you going to do with the amount of money you just put into it? So there's that idea as well. What do you do with this cash that you're not going to put back into TSLY, right? I've taken it out. Is it going into bank account? You're going to do something with your cash. So there's all kinds of questions. It's, maybe a couple different approaches, and it'll depend on the investor.
Okay. So you just mentioned something that I wanted to touch on because you co-wrote a book, Buy and Hedge, and that's about using hedges to reduce your downside, obviously. So, and I also saw that you've personally bought some TSLY or some YieldMax funds. So you mentioned you do it for your customers, but do you do any hedge for TSLY?
All right, a couple things. Thank you for mentioning my book. Nothing about YieldMax is really mentioned in the book. I think there's a section on covered calls, but I wrote the book in 2010, 2011. So, YieldMax wasn't there. Weeklies on Tesla weren't there yet, right? So, I just don't want someone to think, oh, I bought the book and it's not in there. It's not, but it is more about hedging and protection. So, first thing, yes, I own every one of the YieldMax ETFs. No, I do not hedge them myself because I'm comfortable with the risk. I've already measured how much I'm going to invest in those. So, me personally, I'm fine with the amount that I've invested in them. But do I hedge in my portfolio? Absolutely, right? We definitely eat our own cooking here at Zega Financial. So a good portion of my portfolio is hedged using what that book is about, the buy and hedge strategy, where we're using options to protect against the downside moves in the market. So yes, I own the stocks. Yes, I own the ETFs. No, I don't hedge them, but I do hedge other parts of my portfolio.
Okay. So I want to get back to the active management. And this may be a difficult question to answer, but to what extent does the active management affect the returns of the fund versus if it was passive and it was just following a formula?
Yeah, it's really hard to measure that because then what's the passive version, right? Is the passive version what QYLD and JEPI do, where we just buy an option and then just not touch it? You still have to choose which, option you're going to sell, right? That's part of the activity. So I, don't necessarily, it's not something we publish where we say, here's the benefit of active management, but I can tell you that, we have definitely on the way up participated in more of the growth on the way up in stocks like TSLY because of the active management versus, by selling a call and then doing nothing for the week or 2 weeks or however long we're in it. And then on the way down, as the other example, we know selling multiple calls on the way down is better than just selling one call, right? So we know we're earning that premium. So our feeling is that being active definitely has a benefit. Obviously, we think that. But we could have run the strategy in a more, I'd say, mechanical and passive way, but we just have decided not to.
Okay. So I accept that it's a difficult thing to manage, but is it a case where some months you make good calls or good bets and you outperform what would be a passive strategy, and then other months you make some errors and it doesn't go your way, but in the end it's in the positive? Or do you think it's more a case of you can consistently beat a passive option fund by being active if you have a clue about what you're doing?
Yeah, I guess we'd have to define what it meant to be passive, right? So we're not running a passive version for me to tell you that. Are there times where I would tell you this. We are really good at sticking with the concept of the fund, which is harvesting volatility and selling calls. And when that time value has decayed, you cover the call and you do a new one.
Right.
That is, that would be, I guess, that's active, right? Versus being passive, where it's like, hey, there's no time left in this call. I'm just going to leave it on anyway and not sell calls again. That would be more of the passive approach. But again, I don't have a way of measuring between the two. Making mistakes is a hard thing to define, because if I follow the rules of the strategy as I just laid them out for you, there's no mistake. Can the market move against you? Would it have been better if you didn't cover the call? Sure, I'm sure there's times that has happened. Are there times where it would have been better to not roll them? Probably. But it's really measured two different active approaches, right, versus one active and one passive. I don't have an answer for you because we don't run a passive version of it. But, when I look at, the way it's, say, I want to use apples to apples here. And so I will, if you use a stock like Apple as kind of a barometer against QYLD, that might be a way to test if we're performing better or not. But look, Apple disappointed after earnings, went from $200 down to, $1.75. So that was more volatile than NASDAQ. So again, it's even still hard to measure that way. So I really can't give you an honest answer there. I don't have any numbers to point to it. But, our belief is that it absolutely makes more sense to be active when it comes to options versus passive.
Right. Yeah, I follow the logic of it. I just wasn't sure if there's a way to translate it into numbers, and it sounds like there really isn't an easy way to do that.
I guess unless I was running a passive version and then compare the two, right?
Yeah, exactly. Okay, So looking out to the long term, if we assume that Tesla stock and Tesla volatility remain in the range that they've been in, which is a big range, for the last few years, take that out of the equation, are there any other potential threats that could affect, that could be risky for TSLY?
We just mentioned Tesla is the, number 1, 2, and 3 risk.
That's the obvious one.
The rest of it. Yeah. Look, there's a lot of different risks outlined in our prospectus. We're doing a lot of CYA in that scenario. But,
sure.
When I think about, the ETF markets and the options markets, there could be, I don't think anything unique to TSLY. Maybe I'll put it that way, right? Hey, if the market shut down for 3 days in the option market due to some disaster, right, and we can't trade in the options market, that presents a risk to anybody who's invested in options. Like things like that I would say are really kind of the risks we're talking about. So I do get the question, hey, if you keep going down in price from high yields, which by the way, we won't always go down in price, right? We've seen TSLY go down and up based on the price of Tesla. But if you make the assumption that we will, distribute ourselves down too far, or Tesla drops too far, would you ever do a reverse split? I think that's something that happens from time to time in ETFs. It won't change anybody's value. It just might happen, right? So I think we always want to make sure the price is high enough. So there could be something like that comes up, but there's nothing unique besides, the volatility and the price of the underlying that would be, that would risk the dividends of these ETFs. There's nothing different about the risk of TSLY versus JEPI or QILD.
Okay. And you mentioned, and I guess I should have couched that question as applying to the YieldMax ETFs as opposed to just TSLY, but you mentioned before with the options market, during disastrous times like the pandemic or the GFC. Are the options markets affected heavily by that? Are there problems with liquidity that would in turn affect these kinds of funds?
Yeah, so liquidity is always a question. It's something that we test ahead of time. We look at the volume of the stock. We look at the volume of the options on the stock. We do actually talk to market makers when we trade. So we're not just firing. I think right now we hold something like 17,000 contracts in TSLY, right? That's a lot. And we trade those every week, right? So that's not something that we just fire out directly into the electronic market like a retail investor would. We actually have market makers that we work through to, I'm not going to say negotiate, but to communicate on how we're going to get those fills. And so we will spread out the volume across multiple sources. So I don't think we're going to have a liquidity problem. I mean, I guess if TSLY was a $5 billion fund, which I don't think it will be, I mean, that might cause some worries there in the liquidity of the options. But again, the market is there, right? The underlying stock has enough, support to keep the options market active enough. So, but it is something that we do look at. Maybe in some smaller names that don't have as much volume in options, it would be something that would concern us. But we don't file for those, right? It's something we do ahead of time to make sure we can handle it.
Yeah. The tickers you have are all household names, so that makes sense.
Yeah.
Okay, changing the subject, looking through YieldMax's website and all the associated sites, I noticed a few different entities. There's Zega Financial, your firm. There's Toroso Investments. So aside from yourself, can you tell us anything about the people that are actually behind the running of these YieldMax funds? Is it you and a team? I noticed in the prospectus, Mick is mentioned. So who are the people behind it?
Yeah, so you're right. There's a lot of entities like all ETFs. There is a trust, there's an advisor, there's a sub-advisor, there's custodians, there's administrators, there's accountants, there's auditors. All of those things get wrapped up when you run an ETF. So the actual advisor on all of the YieldMax funds, the official advisor is Toroso Investments, and the funds are housed within the Title ETF Trust. So those are just, think of those as kind of the entities that are the structure. We are the sub-advisor, which we are the ones, Zega is the one who's actually placing the trades. So we're not actually even the advisor on the fund. We get hired by the advisor to trade the fund, right? That's the relationship between us. Yeah, there you go. Yeah. So, but that's okay. We couldn't do it without them, right? So there is a relationship there, and they're in charge of things like posting to the website, right? The reason you see a website with the positions every day is because that's something that the advisor handles, right? We handle the trading aspect of it. At Zega, we have multiple traders. It's not just me or Mick. I'm sure Mick will be psyched you mentioned his name. He rarely gets mentioned. Mick runs our trading department. We have two other folks that trade at Zega as well. So, there is a team that trades these. It's not just me or Mick. We do have a team of people that trade the options within any of the ETFs.
Okay. And I wanted to touch on the synthetic part of it. Cotton versus polyester. Do you have any thoughts on breathability or comfort or?
Yeah, the synthetic word gets people confused a lot, right? It's a little intimidating.
The synthetic covered calls, actually.
Yeah.
Does that add risk versus if you actually did hold the underlying?
So they're generally speaking, no, right? The synthetic, which is a long call paired with a short put at the same strike. Mm-hmm. Anybody can Investopedia of that, right, to look up what a synthetic option position is. But essentially it has what we call 100 delta, just like stock. So that combo of those two positions, if the stock moves $1, that combo will appreciate by $1, right? If the stock moves down $1, that combo will depreciate by $1, right? It makes you feel like you're long stock. So and you've done a good job of pointing that out in other videos. So I do think that there are some little differences and advantages when it comes to the synthetic combo apply to covered calls. It's a little technical, but I'll go through a scenario. Let's say the stock runs up and you're in a regular covered call where you have stock and a short call. Well, in a vacuum, if the stock runs through your call, you have to pay to cover the call. And in order to do that, you've probably got to sell some shares of the underlying stock to come up with the cash to cover the call. Normal stuff that happens with covered calls all the time. That's how you manage that position, unless you want to carry a debit balance. We already talked about margin is out, right?
Okay.
In an option strategy, you don't necessarily have to do that. With our synthetic, if the stock goes up through our call, we could take that synthetic and roll up the strikes and realize the gain and not have to sell any of our contracts. So what does that mean? It means notionally, I can capture more of the upside because I keep all of my contracts on the way up. Whereas with stock, once I've started selling, I have a lower value of stock, which means I probably have to sell less calls, right? Like if I sold 20 shares, I now don't have an even lot with my covered calls, and I got to sell one less call. But with options, we do something called the jelly roll. It's a weird name, but it's where you take the synthetic and you move it up and strike. What happens is that allows you to realize all the gains of the stock, which should be more than the amount that you have to cover for your call, right? Because the synthetic had 100 delta, and the covered call probably had like an 80 delta, right? You kept the premium, and so you end up actually not reducing your position. So that is one advantage of a synthetic covered call or a regular covered call. So any covered call sellers will know, like, oh yeah, when it goes through the money, I got to sell some shares. With the options, we don't have to. The flip side of that is also true, right? As the stock is going down, right, our calls make money in both scenarios. The short calls make money. But at some point, options expire, right? And that synthetic has to be closed and reopened, right? They're not infinite, like long stock you could hold forever, right? So in those scenarios, we realize a loss. Now, we won't have to close out contracts because the fund itself has already dropped in value, but you would realize losses sooner in that scenario versus, say, a covered call strategy that never actually has to realize, gains or losses in the stock unless forced to, like we just mentioned a minute ago. So there's little differences there of dealing with dramatic moves in the stock as well as expirations that can cause a little difference, but they're all things that, can generally be managed, and it's something that we're absolutely aware of. They shouldn't impact the NAV of the fund at all. It just, would impact things like realized gains and losses of one versus the other.
Right. Okay. And before we were talking a little bit about liquidity with options. So if there was an extreme event like 2008 or 2020 March, is there any potential that it wouldn't exactly follow the path of the Tesla stock price? Would the two separate briefly, or does it always match it exactly?
It should theoretically match it exactly, but what can happen is when options get far away from the money, bids and asks get wider, and we price based off a mark, which is the middle. So if those bids and asks get really wide, maybe one side gets a little wider than it should be, you could see a little drifting in the mark, but that will iron itself out. That's, that may be a short-term scenario. And so eventually, when those options expire, there is absolutely no difference, right, between the change in price of the stock and the change in price of the combo. But in the middle, like let's say when you've got more than a month to go before expiration, you could see a widening of the bid-ask spread and have a little lag. Sometimes it's ahead, right? It could change, on the daily pricing of it ever so slightly. But at the end of it, it's 100 delta to 100 delta.
Okay, terrific. So what I take away from the discussion from today is that TSLY is potentially a match for certain investors who are, as we discussed before, number one, bullish on Tesla stock. That's key. That's kind of a foundation. Number two, understand the synthetic covered call strategy and all the risks and rewards of that. And I think we've covered those today. And number three, are looking for active management of a fund. And if they want to understand, so would you agree with those three things, that would be the match right there?
Yeah, I would add in just that whole alternative piece as a fourth part, right? Investors looking for alternative income, that uses options, right? I'd add that as a fourth. But you're right. Everything else is correct, for sure.
Okay. And then for those investors that want to see the actual options, like the strike prices, the particulars, those are available, as you mentioned before, on the YieldMax website, right?
Yep. We post our positions every day at the close of the day. And actually, when you go into like the YieldMax pages, we'll even post after 3 o'clock the intraday trades that we made. So you can even see real time what we've done during the day and at what prices.
Okay. And then on the... Right. Yeah. And I know some investors want to get into that level of detail, which is great. And then as far as active managers go, if someone wants to get an understanding of how you look at the market in general and investing in general, they could listen to your Broken Pie Chart podcast.
Yes, we do have a podcast that we do that is about the markets in general. We don't usually reference YieldMax directly, but we may talk about the options market. We'll talk about the interest rate world. We'll talk about economic factors. Yep. So really the host of the Broken Pie Chart is Derek Moore.
Okay.
He allows me to come on from time to time. But usually we're posting those weekly. So it's a way just to hear more about what Zega is looking at in the market.
Okay. And we've covered, I think, the risks pretty well, but the full list is in the summary prospectus that you mentioned earlier. It's 11 pages long. I'll link it in the description, and I recommend anyone who's thinking about investing read that first. I want to thank you for your time, Jay. In my video, I said I didn't buy it. I wasn't a fanboy, and yet you still agreed to come on in spite of that because I think you know your stuff really well. So I appreciate your time, and I certainly enjoyed the discussion.
Yeah, me too. Thanks so much for having me.
Terrific. We'll let you get back to managing those options.